Hi everyone, Bill Lethman here for MoneyEvolution.com. In today's video, I'm going to be talking about what you can expect on your 2018 tax return if you make $250,000 a year. So I think most of us have heard about the Tax Cuts and Jobs Act of 2017 that went into effect as of January 1st of this year. So in this video, I'm going to be talking specifically for those of you that might have adjusted gross income in that $250,000 a year range and what you might be able to expect on your tax return when you go to file it next year in April. So as we talk about in some of our videos here, there's actually two factors that determine how much tax we actually pay. The first one, of course, is the actual income tax rate that we pay across all of our levels of income. But the second one is the amount of our income that's actually subject to tax. So we're going to get into both of these in a little bit of detail here. Let's first start off with the new tax table and how it compares to the old tax rate. So one thing you'll notice is that pretty much across the board, almost all of the tax rates are actually a little bit lower by anywhere from 2 to 3 or 4 percentage points for each one of the income tax brackets. There's actually one category here, however, in the married filing a joint tax return as well as the single category, where in that one category your tax rate is actually going to be a little bit higher. So for married filing a joint tax return, your income that's between $400,000 and about $425,000 a year will actually be taxed at 35% compared to the old rate of 33%. And then if you're single, they really get you. There's a bigger spread there between $200,000 and about $425,000 a year. You're going to pay 35% tax on that portion of your income compared to the old rate of 33%. But again, across the board, all of the other levels of income are actually going to be a little bit lower there, but except for those two categories. The other things, again, talking about how much of our income is subject to tax, one of the things that was a benefit for many of you is the increase in the standard deduction. So they pretty much almost doubled that from what it was under the old rule. So married filing a joint tax return, that standard deduction went up from $13,000 a year to $24,000 a year. And for single tax filers, it went from $6,500 a year to $12,000 a year. So for any of you that are using the standard deduction, that's going to be a real benefit to you. They did, however, eliminate the personal exemption. So we used to get $4,050 in 2017 for every person that we deducted off of our income tax return. That was for ourselves, for our spouse, and any dependent children. Now that's completely been eliminated. They did, however, make an expansion to the child tax credit. For any of you that have kids under the age of 17, they did make an expansion to that. Formerly, a lot of people that didn't qualify for the child tax credit are now able to get that credit applied to their income tax. I'm not going to get into too much detail on that, but something to look into if, in fact, you have kids under the age of 17. They did make some changes to the state and local taxes, and what they did here essentially was limit the amount that you can take off of your itemized deductions for any state income taxes and local property taxes, and they're limiting that now to just $10,000 per year. So for some of you that have high property taxes or live in a high tax state, that could be a real negative there, meaning that you're going to actually pay taxes on a much larger portion of your income there. So let's take a look at a couple of case studies here. The first one we're going to take a look at is somebody that's filing using the standard deduction, and we're going to assume for both of these examples here that it's a married couple filing a joint tax return and they have $250,000 of adjusted gross income. We're also going to assume that they have a couple of kids that up until this year were able to take some personal exemptions, so they had a total of 4 personal exemptions that we're going to factor in there, and again, they're using the standard deduction. So let's take a look. Under the 2017 tax rates, $250,000 was their adjusted gross income. We're going to subtract the standard deduction of $13,000 a year. Those 4 personal exemptions total $16,200, again subtracted from our income, meaning that $220,800 was actually the amount of our income that was subject to tax. And then running that through the tax tables came out with $48,707 was your total federal income tax according to those tax tables. Now with the Tax Cuts and Jobs Act, $250,000 of income, we're going to subtract $24,000, that higher standard deduction. We don't get anything for personal exemptions, and we're going to assume, even though they have children, we're going to assume that those children do not qualify for the child tax credit, so there's 0 personal exemptions there, meaning that a slightly higher amount, $226,000 of your income, is going to be subject to tax. And then running that through the now slightly lower tax rate tables, $42,819 is the total tax, meaning that this person saves actually about $5,776 less in income that they're paying for 2018 than they did for 2017. So in this case, it really helped under the new Tax Act there. Now let's take a look at somebody that's filing some itemized deductions here. Again, married, filing a joint tax return, $250,000 of adjusted gross income, those 4 personal exemptions, and we're going to assume that they have $25,000 of state and local property taxes, and they also have some mortgage interest of $15,000 a year. Now let's look at how this comes out. Under 2017, they had $250,000 of income. We're going to subtract the entire itemized deductions of $40,000. They're also going to get that personal exemption, $4,050 per person, $16,000, meaning that $193,800 was the total amount of their income subject to tax, and then running that through the 2017 tax tables, $41,148 was the total federal tax. Under the new rules, under the Tax Cuts and Jobs Act, $250,000 of income, they're going to take itemized deductions of $25,000. They actually lose $15,000 of those state and local property taxes because they're capped out on just $10,000 as far as the deduction that they can take. Their taxable income is $225,000, and their total federal income tax, even though it's going to be at a little bit better tax rate table, $42,579. So in this case, they're actually going to be paying about $1,543 more in taxes under the new rules versus the old rules. So I think the moral of this story here is if you have multiple children, 2, 3, 4 children, and you're losing those personal exemptions, that's going to bump up, of course, the amount of income subject to tax. And if you have a lot of high deductions, especially those state and local property taxes, that is also going to be a limitation, meaning you're going to be paying potentially more of your income subject to taxes under the new rules there. So let's talk about some action steps here, some things that you can do before we go to file our income tax next year and really think about how this Tax Cut and Jobs Act is going to possibly impact your individual situation. So we also want to understand what our effective and our marginal tax rates are today versus what we expect those to be in the future. And there's a lot of tax planning that can be done just by simply knowing that. So one of the things, for example, that we do here in our office is we do comprehensive financial planning. And one of the things that is a part of that is a complete tax analysis where we can look at what your tax rates are today, and then we could put some projections forward to see what those tax rates might be out into the future and even into retirement as we start talking about taking retirement plan distributions and factoring in Social Security and pensions where we started getting into some more of that variability of returns. One of the primary purposes of this is to understand maybe how we're saving and investing our money for retirement as it pertains to our income taxes. So in other words, if we're in a tax bracket today that we believe is going to be higher than it is in the future, we might be better off to take traditional tax deductions, putting money into traditional IRAs or 401k plans, taking that tax deduction now and paying taxes on it later. However, if we believe we're in a lower tax bracket today than we are in the future, it might be better to consider Roth contributions instead of those traditional contributions. So those are the things that we run through our financial plan. We call it Wealth Vision, and we offer a free introductory call with me to see if it's something that might be right for you. Generally what we'll do is we'll spend about 10 or 15 minutes, learn a little bit about your situation, answer some questions that you have, and find out if it's something that might make sense. So if you're interested in that, we'll put a link right below in the description. You can also call our office at 248-731-7829, talk with my assistant, and schedule some time to chat. Hope you got some great value out of the video here today. Again, if you haven't already, make sure you hit that like or subscribe button, and I look forward to seeing you back here in one of our next videos. Thanks.